The mood for Tokyo shoppers is one of excitement as the country enters the traditional spring season sales. But there's not the same feeling about Japan's economy, which narrowly avoided a technical recession last year. Quarter-on-quarter GDP grew by 0.1%, revised after an initial reading of negative 0.1%. That tiny growth was driven by companies' stronger than expected spending on plants and equipment. Markets didn't react positively to the new figures, with the Nikkei 225 plunging more than 2% this week. Analysts say this is because markets expected stronger growth, ending the stellar rally which saw the index surpassing its previous all-time high last month.
The market was expecting 0.3% quarter on quarter. What they got was 0.1% quarter on quarter. You look at the composition of that GDP number, it really was down to investment.
And readings for January this year show the economy shrank an annualized 0.5% from the previous month, driven by a decline in car production. Exports also fell 4.6%, signaling lower revenues. Analysts forecast that if January's trend continues, Japan's GDP will contract an annualized 2.9% in the first quarter of this year. Japan has another major barrier to growth: low consumer demand. This is despite the Bank of Japan maintaining negative interest rates, trying to encourage more lending. Experts say low spending is because of people's expectations that prices will fall further, an attitude stemming from Japan's long deflationary period after the late 1990s.
You've got such deflationary mindset embedded in Japan households, is that it's very difficult to make them go out and spend, even though you've had negative nominal interest rates. I mean, you've got to remember that the policy rate in Japan at the moment is minus 0.1%. You've got yield curve control. The 10-year bond is anchored at 0%, and yet people still aren't spending. And it's very, very difficult to actually get that mindset, break out of that mindset, which has now been in place now, arguably, for 30 years.
The Bank of Japan meets this month to discuss possible increases to interest rates, a decision that would weaken consumer demand and slow growth even further. Emre Boz, TRT World.
For more on this, we are joined by Seijiro Takeshita in Shizuoka, Japan. He's a professor at the University of Shizuoka. Thank you very much for being with us this morning. As we've just heard in the report by our colleague, Japan's economy narrowly avoided recession. What's the state of the economy in Japan?
Well, as you reported, the capital expenditure, which is spending by the corporations, are continuously fairly brisk, considering that there's a lot of investment to R&D, but particularly into the rationalization process to basically mitigate the lack of human resource and forces, which is very much in a troubled state. But the private consumption always remains to be a problem. Obviously, people's very conservative mind is offsetting, the spending patterns, and the propensity to spend hasn't risen because of that, in spite of the fact that we are seeing the rise in nominal wage.
Right, and if you could summarize them, what do you think are the main challenges facing the East Asian giant? We know it's a country with an old population, but at the same time with really amid the highest amounts of savings in the world.
Well, we're expecting, and we have been expecting over the past 30 years or so, of that, large amount to be shifted into investments or spending, but it hasn't taken place. Partly because of a very conservative mind of the Japanese, very much risk-avoidant nature of the Japanese consumers, but also due to the fact that we're not really seeing the wage rise in the past 20 years. Now, this year we will see the nominal rise, but on a real wage basis, because of the inflationary state, it still is a minus. And if you consider that, external environment, it's totally understandable that the Japanese consumers aren't spending. So a lot has to do with external factors, as with the case in Japan, always considering the vulnerability of our economic structure towards, things like external prices such as oil.
Absolutely. And as we've seen, Japanese producer inflation grew more than expected in February, and further factoring into expectations at this point that the Bank of Japan is now close to ending its ultra-dovish policy. Do you agree? And how historic a decision would that be?
Well, I think it depends on how you define it. To basically rectify or correct this excessive, inclination towards, staying at the zero rate. Well, to normalize the rate, yes, we are going to see that. But I think there's very little room for Bank of Japan to maneuver. I think a lot of people are thinking that they have a very deep pocket. I do not believe that is the case. So a lot has to do with how the Fed moves and how Japan can partly comply. For that reason, I think there still will be a lot of eyes towards what the Fed will do in the future, because I don't think there's a lot of room for Bank of Japan to maneuver, considering its state of the economy and the fact that Bank of Japan itself do not have the deep pocket to comply like other central banks like in Europe or in the States.
And just a last point, what do you expect in terms of what the Fed will do? Analysts expect the first cut to take place in June. Do you agree? And if that will be the case, how would the Bank of Japan react?
Well, I think that would be a fairly positive factor for Bank of Japan would be a good plateau for Bank of Japan to normalize its ultra low rate policy. And that for that reason, I think the deviation of the interest rate between the two countries will mitigate. So I think that will be a fairly good news, for Bank of Japan in the future. But of course, that's a very mid-short, estimate. I think in the long run, they still have the structural problem that they have to tackle with.
Sejiro Takeshita, thank you very much for being with us on the program.
Thank you.
And now a quick look at some of the other top stories from around the world. The US federal budget deficit has widened sharply in February as higher interest rates continued to weigh on the government's finances. Overall gap increased by $296 billion last month to $828 billion for the first 5 months of the fiscal year. Interest costs have totaled $433 billion during the period, up by 41% from a year ago. Argentina's monthly inflation slowed for a second consecutive month in February as the peso continues to strengthen against the US dollar. Consumer prices rose 13.2% from the previous month, down from the 20% increase recorded in the first month of the year. But the annual rate rose to 276%, cementing Argentina's position as having the world's worst inflation. Cathay Pacific has reported its first annual profit since the COVID-19 pandemic, fueled by a rebound in travel demand. Net profit at Hong Kong's flag carrier came in at $1.25 billion, compared with more than $800 billion losses in 2022. The company has also announced plans to expand its workforce by around 20%, or 5,000 people this year. And PwC Australia has slashed another 329 jobs as part of a major restructuring in the wake of a damaging tax leak scandal. The Big Four firm has also announced that 37 partners will be accelerating their retirement over the next 9 months. The accounting giant was rocked last year when it emerged staff had shared confidential information about legislation designed to clamp down on tax avoidance.